Welcome everybody to Safe Option Strategies and welcome to our presentation of Never Lose Money. My name is Jeffrey Dunyan. I am the owner and founder of Safe Option Strategies. You are about to watch a recording of our introduction presentation that was done live on May the 20th. Since the 20th of May, with the exception of the last couple of days, the markets have had a pretty big sell-off, pretty brutal sell-off. The month of May ended as the worst May, I believe, since 2010 that the U.S. markets have experienced. There's been a nice rebound the last couple of days, but I'm telling you right now, more turbulent water is in front of us. There's going to be some major back and forths that go on. Even after the close of the market today on a fairly good day in the market, futures are pointing down strong tomorrow on more concerns of trade wars. I'm going to let you watch the same presentation, and if you saw this presentation in the last couple of weeks, maybe you want to skip towards the end or fast forward towards the end of it, but there's going to be one major difference. If you have not done so already, and you will take a minute at the end of this presentation and click on the link that is on the same web page as what you were directed to and inquire about our pricing. I'm going to do something very unique. I'm going to do something different than I've ever done before, and I'm only going to do it from now until next week, Monday. On Tuesday of next week, I'm going to be going out of town for a little while. I'm still going to be doing live classes for my students. I'm still going to be monitoring trades and taking care of everything that needs to be taken care of that my employees don't do for me. But I'm not going to do any other marketing. I'm not going to do any new promotional classes. So I'm going to do a very special, very unique offer. There's no obligation to buy anything, but at the end of this presentation, simply follow the link and inquire about what we're doing with pricing. I think you'll really like what we're going to do this weekend. We're going to make it a little bit easier to be involved in the program than I think we've ever done before, and really try and make it simple for you and very, very affordable for you. So enjoy the presentation. You know, I ask people the question all the time, if I could show you one thing that would guarantee better results than what you're getting right now, would you do it? Do you know the reflex answer? People don't even consider what they're saying. The reflex answer is yes, of course I would do it. And then I show them everything we're doing here, and I show them that there's a small price attached to learning how to do this. And they say, I don't want to do that, or I don't want to spend any money to learn how to do it. And think about that. Again, you're just being honest with yourself. You don't owe me anything. You're being honest with yourself. Would you do something different if it meant getting far better results? And you say yes, and then we tell you what to do, and you say, no, I'm not going to do that. I'm not going to try that. That's like, and this is a kind of a harsh example, but that's like the guy that goes to the doctor and his heart is on the verge of exploding, and it's because of the way he eats, and it's because he doesn't exercise, and it's because of, and the doctor says, do you want to live another 20 years? And the guy says, yes, of course I do. Doctor, I'll do anything if it'll give me another 20 years, because this heart condition is really scaring me. And the doctor says, you need to stop eating ice cream. And the guy says, I'm not going to do that. Okay, right, well then you really don't want to live longer. No, that's an extreme scenario. I realize trading stocks, trading options is not the same as a heart problem that could literally end your life. I recognize that. So forgive me if that's a little too extreme an example, but it's kind of the same in principle. Okay, a lot of information to cover, and I promise I'm going to do my best to get through this quickly. And I'll make you this deal as well. Okay, last deal. I'm sorry, last deal. If you'll stay tuned into what I'm showing you, I will teach you some things that will help make you a better trader. Even if at the end of this you have no interest in our education, I'm going to teach you a couple of things that'll help you. All right, I'm going to show you how to trade with little or zero risk through something called collar trading. Okay, I'm going to show you how to adjust, how adjusting trades and using trade adjustments can protect all of what you do. Everything you do in the market, if you do it with adjustment strategies in mind, you're going to be a more profitable trader by far. I'm going to show you how to do a much lower risk cash flow strategy. Now, these three things right here that I've got on the screen, this covers everybody. Okay, if you are a stock trader and you have no interest at all in trading options, but you really want, you're okay with owning stock, you want to protect what you have, I'm going to show you something that is going to help you trade with little or zero risk. And it's the safest way I know of to trade, and it can be incredibly profitable. If you don't want to own stock, if you just want to trade with options, maybe you have a little bit smaller portfolio, maybe you have a little bit bigger, just a little more risk tolerance, a little bit bigger risk tolerance, but you don't want to own any stock, I got something for you. If you've built up a portfolio and you're looking at it and you're saying, I've got this $50,000 or $100,000, whatever it is, I'm just throwing out numbers there. I've got this amount, and if I could just make X dollars a month on it, if I could just make 5% without question every single month, or if I could just make 2 or 3%, and that would help me pay the bills, that would help me travel more, that would help me have a few more things in life and enjoy this money I've put away, I've got something for you. Okay, in order to cover all three of these in an efficient amount of time, I'm going to go very fast. If you're with me live, you've already heard me mentioning recording. This is being recorded. So if you're watching it live, you will have an opportunity to go back and listen to a recording and go through it a second time. If you're actually if the first time you're hearing this is as a recorded version on our website, you can stop, you can rewind a little bit, you can go back, and that allows me to go really, really fast and cover a lot of information without the fear of losing you. Okay, let's start with zero risk trading. Is there such a thing? I'm going to tell you the truth about zero risk trading. Everybody that does any type of investment education, everybody that trades money for people, everybody that's tied into the stock market in some way, in some shape, and is giving you advice, they all tell you the same thing. All trading comes with risk. Okay, you know the stock market is risky. Don't trade with money you can't afford to lose. I'm going to tell you something, folks. I've done really well in the markets for a long period of time. I've helped a lot of people do really well in the markets for a long period of time. And you know what? I can't afford to lose any money. I can't stand to take losses on trades that I do. I've learned how to adjust and live with those occasions when I do take small losses, but I hate losing money. Let me tell you the truth about zero risk trading. Anybody can do it. If you learn the right way, you can trade with zero risk in your portfolio. It can be done. Okay, let me ask you a question real quick. Why would you ever go without insurance on the valuable things that you own? Okay, whether it's your house, your car, if you've collected artwork, if you have jewelry that's expensive, why would you ever go without insurance on those things? It just makes sense to insure things that have a high value. We do it all the time. Sometimes if we have a loan on those things, the bank makes us do it. We don't even have a choice. You go out and buy a new car and you finance it, you're going to be forced to carry insurance on it beyond just the liability insurance. You go out and buy a house, you have a mortgage on that house, the bank's not going to let you own. The bank technically owns that house. They're not going to let you go without insurance. But even if you own the house outright, you're going to insure it, aren't you? I hope so. And it works really simple. You have a expensive home. You go out and get a policy that will protect the entire value of that home. You might pay a chunk of money for that policy each year, but that's the cost of peace of mind. That's the cost of having it insured. And all this is just natural to us. We don't even think about this. For most people, their home is their biggest asset that they'll ever own. Do you know for most other people, for most people, the second highest valued asset they will ever own is their retirement or their trading account? And yet, most of the time, we don't even think about insuring it. And oftentimes, it's because you don't know how. Now, even if you're somewhat averse to options, or even if you're an option expert, most people that come and view this presentation of mine have never considered using options, specifically a long put option, as an insurance policy for their stock. But do you know back in the early 70s, that's what a long put option was designed to do, was to be an insurance policy for your stock? And it works real simple. You buy a stock, you buy a long put option that works just like an insurance policy. You pay a premium for it. If the stock price were to go down, the value of the long put option goes up, and you can protect the loss of your asset with the increased value in your insurance policy. One thing offsets the other. It's simple. That's the way an insurance policy works. I go out and buy a $50,000 car. I get an insurance policy, someone crashes into my car, now it's only worth $20,000. Hopefully I got a good insurance policy. Maybe I paid a little more than some people pay for their insurance, but hopefully my insurance policy is going to cover that $30,000 that I'm suddenly out. The value of my insurance is suddenly a lot greater as the value of my asset is suddenly a lot less. A long put option works exactly the same. Exactly the same. Something as simple as learning how and when to add a long put option to your stocks will protect you like an insurance policy. And we can do one thing better than that. We can use a covered call strategy, a very simple covered call strategy to get someone else to pay for it. Now, I'm going to show you some real examples of this in just a second. I want to talk about one other thing before I get into this. The way to profit with this, and that's the way to protect yourself. I can teach you in a day or less how to protect yourself every single time a stock that you own is moving into a bearish trend, or every single time the markets go haywire like they did a couple of weeks ago with all the fear of no deal with China and no trade deal and higher tariffs, and the stock market took a little nosedive for a couple of days, got a little bit of it back through the week, and then sold off again at the end. I mean, this is all what's happened in the last couple of weeks. You've lived through it. Every time something like that happens, I can teach you really easily how to be protected and not lose money in those situations. But you want to profit at the same time, right? We profit using this strategy called a collar trade. We profit by using the long puts to help us cost average and add shares of stock. So using that, and everyone know, hopefully, even if you're newer to the market, you know what cost averaging is, right? You buy a stock at $100 a share. Let me just demonstrate really quickly. You buy a stock at $100 a share, and that's your total investment is $100. The stock drops down to $50 a share, and you buy another share at $50, and now your total investment is $150, and you own 2 shares of stock, so you divide that by 2, and your average price per share is $75. That's cost average. Now that's a real oversimplification of what cost averaging is, or dollar cost averaging on your stock. Okay, real simple. Now, the only challenge in this is that, let's say you're doing this times 100 shares. Okay, originally 100 shares at $100 a share is a $10,000 investment. Okay, that's, for some of you, that's not bad. For some of you, that's your whole portfolio or double your portfolio. But you've got the money, obviously, to own 100 shares of stock, but now you want to average the price down. You got to come up with another $5,000. Where's that $5,000 coming from? To get your average cost down to $75 a share, you got to come up with another $5,000, and you got to hope that the stock eventually gets back up to $75 a share to be at a break-even point. So the downside to cost averaging is, where are you coming up with the additional money to be able to lower that average price per share on the stock? When you add this long put option like an insurance policy, it works like this. You buy the stock, you buy the long put, you factor in the cost of what that long put is. The stock drops, you use the money from the sale of that long put to add your next shares of stock. So your next shares of stock didn't cost you a penny. The next share of stock you bought cost you nothing. It was really already covered for, it was already counted for just by having some insurance. And the difference is this: you have that first share of stock at $100, it comes down here, and you've got to spend $50 to get that second share of stock, but you're going to bring in $50 when you sell that long put. And so now you add all that together, your cost is $100 divided by 2 shares, you're at $50 a share, plus the $2 you spent for the insurance. So what happens now is you don't have to come up with more money to add those other shares of stock, and the stock doesn't even have to get back up to $75 for you to be profitable or break even. You're break even at $51 a share, you're profitable at $52, and if that stock ever trades at $100 a share again, you are 100% profitable on that position. Now think about all the time that this is happening. Think about all the time that this stock is going down and it's coming back up. You're not stressing during this period of time, and that is more than worth the cost of that insurance. And you're happy as happy can be when the stock is going back up. Very simply put, a collar trade is owning stock, setting up a long put option with that stock exactly the way you would an insurance policy, and then using a short call option to pay for some of all of your long put option. And collar trades can be set up for very little or no risk. A week ago, when I did this presentation for a group a week ago, and so these prices are off by about a week, but a week ago, we could have jumped into shares of NVIDIA, and NVIDIA was just getting ready to report their earnings. They were just a couple days away from reporting their earnings. We could have bought stock. We could have bought a long put option. We could have sold a short call and had incredibly close to a zero risk trade. Very, very close to a zero risk trade. Instead of having $161.60 per share at risk, we only had $1.29 per share at risk. NVIDIA reported their earnings last week, and I'm telling you right now, had it not been for the way the markets dragged everything down, if it hadn't been for that, NVIDIA would have had a heck of a day because they reported really good earnings. They were up on Friday in the midst of a lot of the rest of the market being down. They're selling off a little bit today, but they got caught up in that whole China trade war talk. And the beautiful thing is right now today, as I'm doing this presentation live with the group that's on live, NVIDIA is trading at 153. And guess what? We have the right to sell NVIDIA at 160 a share. That's $7, $8 loss they've experienced since their earnings. They really got treated unfairly after earnings because they had a great report. That's part of the reason we do this, though, because sometimes things don't seem logical. Company has a really good earnings report, and instead of going up, they're selling off. It doesn't make any sense, right? I mean, to me, it doesn't make any sense, except that the whole market is worried and fearful, and trade talk and China, it's got everyone really spooked right now. We're perfectly protected in NVIDIA. We can still make great money if it moves to the upside, but we're not losing anything with this move to the downside. Doesn't have to be an expensive stock like NVIDIA. NVIDIA is $161 a share, and a lot of people are looking at that and saying, I don't have enough to afford 100 shares or 200 shares of NVIDIA. I'll bet you could afford 100 shares of Ford. Last week, Ford was trading at $10.18 a share, and we set up this same type of trade. And Ford is, they went up a little bit last week. They came back down a little bit. The good news is we're protected either way. Stock at $10.18 a share, a long put option for 26 cents, and we got someone else to pay for most of that long put option. And Ford could go back down to $8 a share. It wasn't too long ago, Ford was at $8 a share. And that doesn't sound like a lot from $10 to $8. That's 20% drop. That's a 20% drop in the price of the stock. Ford could go back to $8 a share, and you know what we would lose? About 20 cents a share in a worst case scenario. That's the worst thing that would happen to us. But if they went down to 20 cents, or excuse me, if they went down to $8 a share, we would use that whole process that I just showed you a minute ago of using the profit in those long puts to buy more shares, and we would increase our position in Ford and have a fantastic position moving forward. Doesn't have to be expensive stocks that you do this with. Okay, here's one. Now, you can also get creative. You can get out of the box a little bit. A few weeks back, when Micron was trading up around $43 a share, we got stock. We got our long put options as our insurance policy. We got our short calls. We didn't have a very high price per share. We only had 9 cents at risk, but we did something a little bit different. We got a little bit out of the box. We did more long put options than what were needed for the 500 shares of stock that we did. Today, the day I'm recording this, the day for those of you that are live, you know what day it is, but for those of you that are live, as of today, Micron is trading at $34.92. Think about this, okay? This is the trade we set up a couple of weeks ago. Micron is down almost 20% from where it was at only 2 weeks ago because we got a little creative and a little out of the box. We're down $4,100 on our stock. We're up $4,400 in profit on our long puts, and we're profitable another $1,000 on our short calls that we added to the trade. And on a stock that's down 20%, we are up 7% profitable right now. Do you remember what the market indexes finished at for last year? I know we're already at the end of May, but do you know what the market averages finished last year? They were down. They were down 5, 6%, 7%, I think, for the S&P. We're up 7% on one trade that we've been in for a couple of weeks with a pretty good chunk of money. You could have thrown your whole portfolio into a trade like this and been up 7% right now and have reversed and doubled what the markets did last year, because you're reversing it with 7% to get to break even and 7% more to the upside. And the beautiful thing is, no matter what Micron did, we didn't have any chance of losing money. And even if they'd have gone the other way and skyrocketed up, we could have made 7% on this trade. And that's just in the earliest couple weeks of this trade. We did a Micron trade with our students a little over a year ago. Every student of Safe Option Strategies that participated in this program had the details of this trade sent out to them. And if you look at this stock chart right here, what do you see as the two worst possible times you could have got into Micron? Right here or right here, right? Those look like the two worst times you could have gotten into Micron. You realize we got in right up here? and they're down to 34 right now. They're down here, right? I got to update this chart. This was from about a month ago. And they're that much farther down right now. We got into a trade just like the one I'm showing you. We got a little out of the box. We did 400 shares. We got 5 long put contracts, 3 short call contracts. Okay. We got into this trade. In April, we added 100 shares on exactly what I was showing you with that example of cost averaging down. We added 100 shares. Okay. In May, we rolled our long puts and our short calls. In August, we were able to add another 100 shares because of the drop in the stock. In September, we were able to add another 100 shares because of the drop in the stock. Now, the price of the stock was going way down, but we kept increasing our shares without any kind of significant increase in our investment. The long puts were paying for these additional shares. We made an adjustment in November that was just a roll of the long puts. In January, we added another 100 shares. At the end of January, we added new short calls to the trade. And in February, we rolled out everything and adjusted it. And guess what we're getting ready to do right now? Okay, and that's sold. That was as of a couple weeks ago. That was as of a couple weeks ago. Today, we're at about $34.90, so right around $35. You know what we're getting? You know what's going to go out to all of my students at the close of the market today? Every one of my students is going to get an email saying, guess what? We get to add 200 more shares to our Micron position, bringing our total up to 1,000 shares, and it's not going to cost us a penny. And as of the time, this chart is a couple weeks old, maybe 3 weeks old. As of the time we showed this, Micron was down 27%, and we were up about 25%. Folks, we got in right here, and we're clear down here, and we were profitable 25%, and we've increased our shares from 400. As of today, it'll be over 1,000. Do you realize if Micron ever gets back up around $60 a share, how profitable are we going to be? We're going to be more than 150% profitable because we've added 150% to our share ownership. For no added investment, we've increased our share ownership by more than double. This is what we teach people to do. These are real trades and real profits that we have done over the past little over a year. The most important part of any of this is that we were never at risk for any significant loss in these trades. In many cases, our worst case scenario loss was a few pennies a share. And look how profitable we are. And these are all the trades that we send to our students. A student of mine going back to 2013, he had been in the program, he had been a member of Safe Option Strategies program for about 6 months. And he started this trade in August of 2013. Now, I want you to key in on this number right here. I didn't know it at the time. I did not know it at the time, but he only had $5,000 to trade with. He drives truck for a living. He drives a long haul truck from one end of this country to the other, all over the place. It's all he does every day is drives truck. At the close of the day, he opens up his laptop computer at whatever truck stop he's at, where he usually gets some free internet connection, and he looks at what his portfolio is doing, and he looks at what emails have come from us, and he looks at what he needs to do for the next morning, and he closes his laptop, and he's done until that time the next day. I didn't know at the time that he only had $5,000 to trade with. He put most of it in this one trade. When he shared this with me, he'd been in the trade for about 1.5 years when he shared this with me. And I said, what in the world did you pick JCPenney for? He said, well, I deliver to them. I know the company. I shop there. They're all over the place. And it's what I could afford. Doing what I've showed you already, every time the stock was coming close to an earnings report or it moved into a downward trend, he started adding long put options. Every time it reversed and started going back up, he added shares. He just kept doing this over and over and over again. When he shared this information with me about 1.5 years into this process, so I didn't even know he had been trading JCPenney this way. 1.5 years into this, he showed me that in 18 months' time, he was up 182%. His little $4,350 investment was worth $12,600. About another 8 months after that, I think, he was up 290%. He stayed in this trade for a little over 3 years, just going back and forth, growing his portfolio. At the end of a little over 3 years, he was up 475% in this position. His little $4,350 investment had gone to $25,000. Folks, I would have never have chose a company like JCPenney. He did, and it paid for itself big time. Okay, if you've got a portfolio and your number one goal is to protect it and don't lose any money, but you know you can still grow it, you got to check out what we're doing. We can show you how to do this. We can teach you how to do this. If you don't want to own stock and you want to strictly spread trade or do option trades only, you've got to learn how to adjust trades. In its simplest definition, a trade adjustment is a contingency plan for whatever happens that you didn't expect to happen. Anytime we get into a position, an option position, a stock position, futures, commodities, whatever, anytime you open a trade, you have an expectation of what you think that trade is going to do. Every once in a while, people tell me, no, I'm neutral. I don't care if it goes up or down. I would submit to you that probably in that case, you need it to go up or you need it to go down. You just don't care which direction. And you don't want it to do this. Or you need it to do this and you don't want it to do this or this. Every time we get into a trade, we have an expectation of what the stock is going to do. That's the way the market works. There's no getting around that. We need that stock to finish at or above or at or below a certain position for us to be profitable in our trade. Or we need it to move a certain distance in a certain period of time, up or down, sideways. That's what trading is all about. That's the gamble. That's the risk. Adjusting means we're going to cover the contingency. If what we wanted when we got into this trade was this or even this, we got to know what we're going to do for this. And if you're just trying to protect this with stop losses, folks, when stocks gap up or down and you're trying to protect yourself with a stop loss, you're going to lose money. And you can only add up so many losses before it stings to the point where you're in trouble and you're taking big losses. Even if they're just little losses, they add up. The simplest definition of adjusting a trade I'm sorry. I'm going to get to that definition. This is what most people face. This is what most people suffer through. 3 out of 4, 4 out of 5, 9 out of 10 of their trades go the way they want, but the one that is losing is the one that's costing them an entire winning portfolio. And they get into this situation because they start predicting what's going to happen. If I can't teach you anything else in this presentation, let me tell you this, and please allow this to sink in. You do not know what's going to happen tomorrow. With any individual stock, with any individual trade, with any index, with the markets as a whole, you don't know what's going to happen tomorrow. And all the research and all the due diligence you perform is not a guarantee of what's going to happen tomorrow. That doesn't mean you don't do your research. That doesn't mean you don't use good technical analysis and good fundamental analysis to make smart decisions. You've got to make good, educated decisions. But in the best of scenarios, they're educated guesses. And if you're going to make an educated guess, you have to have a backup plan. You cannot get into trades that don't have the ability to be adjusted. And that's everything we do at Safe Option Strategies. Whether you're a stock trader, an option trader, whether you're trading for cash flow, whether you're trading for aggressive portfolio growth, pure protection, whatever it is, everything we teach surrounds one core principle, and that is don't ever get into a trade that you can't adjust. That's what we teach you how to do here. Hey, a trade adjustment is simple. This is where I kind of got ahead of myself. A simple definition of a trade adjustment is when you roll one or more of your options in a spread trade or a collar trade, or when you add a new option to an existing trade, such that it changes the expectation and the direction of the trade, and you end up with a different target profit or target exit. Okay, that's what an adjustment is. Now, I wish in a class like this, I could give you a whole bunch of examples of adjusted trades. Instead, what I'm going to do is show you why it is so important to adjust trades and know how to adjust trades. The core of our education is teaching you how to set things up so that they can be adjusted, and then when to do the adjustment and how to make the adjustment to a trade. That's what a lot of it is about. Okay, this is what so many people go through. They get a return, they place money on a trade, they get a nice little profit, they add that profit back in, and on their next trade, they're trading with a little bit more. And this is just compounding your earnings and your gains, and that's a smart thing to do. I'm not here to tell you that's not a smart thing to do. And they do that again with another trade, and they do that again with another trade, and then all of a sudden one moves against them. And if you've ever traded options, you know how quickly, when the stock goes the direction you don't want, you know how quickly you can be in a bad situation. You can be down 50, 60, 70% loss in the blink of an eye when that thing goes against you. And all of a sudden, 3 out of 4 trades have worked exactly the way they wanted them to work, and only one hasn't worked, but they find out that they're down 20, 30, 40% in their portfolio or their tradable money. When you know how to trade with adjustments, you're going to do the same thing. You're going to add that profit into the next trade. You may oftentimes go for a more conservative return. That is part of the overall adjustment strategy, is that you may target smaller returns with a trade that has a higher probability, not only of profiting, but a higher probability of a successful adjustment. And then what happens is when that one moves against you, because it was set up correctly, and that's part of the bigger picture adjustment strategy, and because you knew how to adjust it, look at the difference. Same starting amount of money, same 4 trades. This one didn't lose money, the other one did. This guy's up 52%, and the other guy was down 34%. That's a huge, huge difference in where you're at with your trading. It's a major difference. Not something that can be discounted, folks. All right, last thing I'm going to cover, and I think I've done pretty good on the timing of this class. I try not to make these classes too long. A lot of people have gotten to a point, they're listening to this presentation of mine, and they've gotten to a point where what they really want to do, whether they've saved up 10,000 or 20,000, 100,000, 200,000, they want to convert that into some amount of cash flow. And the problem that I have found over well over a decade, I'm not too far away from a couple of decades now of teaching this to people, What I have found over and over again is that most cash flow strategies are high risk and very low probability. And what you want is the exact opposite of that. You want something that has a very high probability and very low risk. And sometimes the only way you can create that is if you know these adjustment strategies and if you know how to work these adjustment strategies. So what a lot of people do, I've seen this pitched by probably a dozen or more competitors of mine out in the market, people who sell some type of investment education or offer some type of advisory service. And what they do is a lot of credit spreads, and they mostly do these credit spreads on the indexes. And the big problem that they run into is that they might string off a record of 80 to 85% of their trades being winners. But what they will never share with you and what they will never be honest about is that the losers are wiping out all of their profits. The losing trades, even if it's only 15, 20% of their trades that they're taking a loss on, those losses are crushing them. I saw one company that they advertised that they had made a 700% return in a year, and they were teaching credit spreads on the indexes. And I had a chance to look at their whole trading record. And here's the big lie. I'm not going to name this company, but here's the big lie. The big lie is that you would have to place every single penny of your portfolio into every single trade. And anytime you took a loss on a trade, you would have to find money from somewhere to replace what you had just lost so that your next trade had the same starting balance as your original portfolio. And then if they fudged the numbers in that way, which is a completely dishonest way to show their profits, but if they showed them in that way, they claimed a 700% return. On the year worth of trade results that I looked at, I set it up against a $50,000 portfolio and showed how, number one, some trades were open for a long enough period of time you could not have possibly put your entire portfolio into that trade because you would not have been able to open the next two trades. All of your money would have been tied up. You simply couldn't have gotten into the next trades. And then I showed how if you took the losses they took on some of those trades, you would have been in such a small amount of money on your next trade that the gains wouldn't have been anywhere near. When I went through a full year of what they were showing, this 700% they were claiming was about a minus 5% overall. They had taken a loss overall in the portfolio of a little over 5%. On a year, they were claiming 700% return. Now, this happens, it seems to happen more with cash flow strategies than with anything else. Let me give you an example of a trade adjustment. I have a chart in here from a couple of years ago, an option chain from a couple of years ago. But I like the example, and it's just, I've got a little lazy and didn't put a new one in here. These are all credit spreads that I have on here. Here's a bull put spread on Boeing, a bull put spread on Best Buy, a bull put spread on Amazon. And this is when the market was really in just a upward skyrocket direction. Boy, credit spreads were the greatest thing in the world and people were making so much money on them. And here's the problem. Even though these are fantastic returns, ROR stands for return on risk. Two people just typed in a question, what does ROR stand for? ROR stands for return on risk. When you're doing a credit spread versus a debit spread, instead of saying return on investment, you say return on risk. It's just the correct way to say it. So these are fantastic returns. These are phenomenal returns. But do you want to know the number one problem with a bull put spread? If suddenly that stock turns and goes against you, if it has a pullback, you're stuck. There's no easy way to adjust that trade. It's a great return. It's fantastic if the trade works out. But when it doesn't, you can take a 40, 50% loss in the blink of an eye on a bull put spread that goes against you. Consider this. Same company, same expiration day, same strike prices, same amount of reward, same amount of risk. okay? Your debit is your risk in this trade. Your difference between your strikes minus the credit you took in is your risk in these trades. All things are mostly equal. On the Best Buy one in the middle, it's a little bit less. On the Amazon one at the bottom, it's a little bit less. On the Boeing trade, it's exactly the same. You want to know the difference? These are in the money debit spreads on the left, and they're adjustable. If that stock had turned and suddenly gone against us, remember the adjustment, or the definition of an adjustment? It's just a roll of an option. A debit spread that's going against you is 100 times easier to adjust than a credit spread going against you. And there are other trades besides these ones that are far safer cash flow strategies, that can be adjusted. So when they go against you, you don't get wiped out. You know, the worst thing in the world is when you're trying to create cash flow and you've got $10,000 you're working with, and you need to find a way to make a couple percent on that every single solitary month, and you take a trade that gives you a 20% or a 30% loss, and now you've got $7,000 or $8,000, and now you've got to make 6% a month, 5% a month instead of 2 or 3. That gets really hard. It only takes one ugly loss on a cash flow trade to really screw things up. I talk to people all the time that run into exactly that problem. Okay, I'm getting towards the end of my time. Our cash flow strategy trades last year produced a return of 88% in a market that was down. It was up until October, but it ended up down over 6%, depending on which of the indexes you looked at. That's what our cash flow trades produced. Every single one of those trades are accurate trades in terms of the results we produced. Our spread trading, more for growth than cash flow. This is for people who are reinvesting their earnings, reinvesting their profits. We're up over 20% in a market that is barely up over 8.5% this year. We're more than doubling what the market is doing. That's just this year. How would you like to be up 20% this year? Markets are only up 8%. These are our results. We only started doing the cash flow trades a couple years ago, but we've had fantastic, we tested them for a couple years before that. This column represents collar trades that were entered during that calendar year. This is for anyone that were in the collar trades for the second year in those collar trades. It's still a yearly return, but it's for the second full year of collar trading. Folks, we outperform the markets like crazy. And you got to ask yourself the question, are you outperforming the markets like this? And if not, do you want to? See, I told you I would be really, really honest with you. I'm not here to teach you to turn $10,000 into $200,000 in a year. I've never done it. People who have done it and are honest about it will tell you that they got lucky. A lot of people will tell you that they've done it and they never have. And even the people who got lucky, they can't teach it to you because you can't teach a person to get lucky the way they did. These are real results. These are real annual results. And these are realistic expectations if you want to learn to do what we're doing. Okay, you've all heard this before, right? Feed a man to fish and you feed him for a day, teach a man to fish and you feed him for life. I love that saying. I grew up hearing that. You've probably heard that 1,000 times or more in your life. I've heard that thousands of times in my life. And I love the saying, and it makes a lot of sense. People ask me sometimes, can I just follow the trades you're doing and just do an advisory? And the answer is no, you can't. You've got to learn how to do this. You have to learn the education. For anyone who learns the education, they will also get trades sent to them on a regular basis. I always, not always, but after hearing this a whole bunch of times, it occurred to me that there was one small problem with this little adage right here. One small problem with this. What happens if the man starves while he's learning to fish? Okay, I've got a brother-in-law and his kids, my nephews, are great fishermen. I mean, they're good. I'm telling you, I go visit them in Idaho once in a while, and we'll go fishing in the Snake River or a river closer to their home. And these guys, they'll cast in and they'll bring out fish. And I think that I'm doing everything exactly the same as they're doing, and I'm getting nothing. And they're trying to give me pointers. They're saying, well, you're trying to set the hook a little too soon. Okay, so I try and be a little more patient. Well, now you're waiting too long, and the fish has gotten the bait off the hook and spit the hook back out. I'm like, come on, I'm using the same bait you guys are using. I'm casting out to the same spots. You're helping me set up the hook and the bobbin, and it's all about the same. It's like, what am I doing? Well, they've done it longer. They've got a feel for it that I don't have. If I ever got lost in the wilderness and they weren't going to feed me while they taught me, I would starve to death. They'd be fine. I'd be the one in trouble. What I have tried to create at Safe Option Strategies for all my students is a way to teach you how to do this and get you really good at it, but we feed you from day one. Do you know you can join Safe Option Strategies, and within the first few days you're in the program, you will see trades that we're doing that you can get into and that you can copy, and that's how we keep you fed. You can do the same trades we're doing. We send out these trades to all of our students, and it's fantastic, and they love it. And we've got great results. I know one of the hardest things for any of you that are listening to this presentation right now is that there's a good chance you've spent money on other programs before, and that makes it incredibly difficult to want to spend money again. Folks, back in 2000, 2001, I went through $35,000 worth of investment education. You know what I got for that? Basic options and advanced options, basic stocks and advanced stocks. I knew nothing about trade adjusting. I knew nothing about collar trading. I knew very little about the right way to spread trade and how to adjust a spread trade. I knew nothing about cash flow strategies. And I've been there. I know what you're going. I know what it's like to go through that kind of education and then wonder, how in the world could I ever spend money on anything again? I honestly believe if you'll take a close look at this, if it's in your price range and you'll give us a chance, no matter how you feel like you've been burned in the past, this is going to be different. It's the last purchase you're ever going to want or need to make. I'm so confident that if you will learn to do the things that we're doing here at Safe Option Strategies, you will be a profitable trader. I'm so confident in that I offer an unconditional money back guarantee on the cost of the program. Nobody in this industry, a lot of companies give you like a, they'll refund your money for a week or two. You can change your mind for a couple of days. Maybe some of them have like a 30-day guarantee. I guarantee this program unconditionally. I don't care if you've been in 6 months or a year or 2 years. If you're not making money doing what we're teaching you, you're entitled to 100% refund. And the only criteria I have ever used to measure the success of this company is if my individual students are successful. I spend time on the phone with them. I trade emails with them. I make sure they're learning this stuff and getting good at it so that the day will come that they can do it with or without us feeding them. But while they're in that learning process, we keep you well fed and help you make money. We have 3 different programs. We have a collar trade program, a spread trade program, and a cash flow trade program. And all of them, we keep things so simple here. One thing I will not do to anyone is try and get them in the door for a little, $50, $100 price and then start upselling them. Because I promise you, those companies that are out there advertising that you can learn everything they want to teach you for 50 or 100 bucks, it's a lie, folks. Don't buy into that lie. They will get you in the door for $50 or $100, and then they'll start upselling you. And the majority of them, the ones that even come close to offering similar content to what we offer here, they will upsell you to the tune of $10,000, $12,000, $15,000 eventually. And it doesn't come all at once. They'll get you in the door for $100, and then they want to upsell you to something that's $1,000 or $2,000, and then from there they want you to add this super deluxe package that has all this different stuff, and it's another $3,000 or $4,000. But their end game is to get you to the tune of $10,000, $15,000. And even the ones that go up to that price, they don't cover the same amount of content with the same amount of live stuff that we do. You know, we do live classes every single day at Safe Option Strategies. Our students have access to live classes, and if they're not able to attend the live classes, they can watch a recording of them later. The core education, the basics that teach you the strategies and the adjustments, that's all pre-recorded. That's all online for you to go as fast as you want or as slow as you want. You can go through it over and over and over again. But in addition to that, that's over 55 classes. In addition to that, we do live classes every single day, and those live classes are so that every day we're looking at our open trades, we're looking at what the market is doing, and we're making sure you understand the thought process and why we're doing what we're doing and why we're thinking about the next step that we're thinking about. Nobody joins this program and ever feels like there's a lack of information. When you combine programs, we offer some pretty nice discounts when you combine programs, and we make it very attractive to get all three. And I will do this for anyone, whether you're listening to this live with me right now. Oh, and by the way, for those of you that are on live, when I wrap things up in a minute, I'm going to stay here. A bunch of you have asked questions. And I wanted to get through all this information because I know a lot of people will be watching the recording. So I'm going to stay on and answer any questions you have. If you're watching this as a recording, email me when you're done if you have any questions, and I'll take the time to email you back and answer. But for those who will email or call at the conclusion of this presentation and simply ask me, what is the discount we are offering right now? I've got a discount in place right now only for those who will take the time to email or call. You've taken some time out of your schedule. Probably, I think I told you 45 minutes, we're probably closer to 50. You've taken some time out of your schedule. That's a very proactive step. Do one more proactive step. Send an email or call, and we'll get back to you right away. And just simply ask me, what is the current discount or what's the best price you can offer? I've got a discount that I'm going to do from now until the end of the month that I think is going to blow you away. This is going to be more affordable than you ever imagined, and it's going to be more affordable than probably anything you've looked at that even comes close to what we offer. It's not a $100 thing. It's not a $500 thing, folks. We're not trying to be a cheap education. I try to make this affordable so that people can do it, and I guarantee you it's worth it. And I've had people tell me, I've had people that have gone through what I went through 17, 18 years ago, that have gone into the $20,000, $25,000, $30,000 education programs. I've had conversations with people that have joined my program and told me later on, if I had known what was in this, I would have paid 10 times for it. And I'm a nice guy, so I don't ever say, oh, you could still do that. It's tempting, but I don't do that. I've had people tell me that. They've said, if I'd known how much content there was and how good this worked and how good you are at providing us information and helping us, I would have paid 10 times what you're asking. But the way to get pricing and to get the discount pricing, you got to do one last proactive step, call or email. Folks, as sincere as I can possibly come across, let me end with this. Whether it's $1,000 or $10,000, I've got to do something to earn your trust for you to want to move forward with this program. You may or may not have felt my sincerity and my honesty as you've listened to this presentation, but if you're in doubt of that, call me. I will call you back. If you're in doubt of anything, email me. I'll email you back. I won't chase you for your business. I will just answer your questions honestly and thoroughly. And if we are a right fit, you'll know it. And we'll start working together, and I'll start helping you make some money that you never thought you could make in the markets. And if we're not a right fit for you for some reason, I'm going to wish you nothing but the best of luck. I'm still going to take time to answer your questions. I've had conversations with people, and at the end of them, they say, well, I still don't know if it's for me. That's okay. I get it. Email or call. If you have to leave a message, I promise we'll get back to you. And see if this is a right fit for you. Get what the pricing is. If you email or call, I'll send you a quick email that's got details on the discount that we're offering right now. It changes from time to time. That's why it's not just posted on our website as the same thing all the time. And we've got a phenomenal discount going right now. It is reserved for those people that will call or email. I'm going to wrap up right there. If you're live with me, stay online. It's going to look like the presentation is just pausing for a minute. If you're listening to a recording, thanks for taking the time. I wish you the best of luck. Hope I hear from you. Bye-bye.